What's going on, everybody? Chef here. Welcome back to the channel. All right, guys, in the video I made on a Monday, the last about minute and a half kind of got cut short. And it was talking about a strategy that has just been more favorable, not only in bear markets, but in the current cycle that we are in. Okay. Now, before I get into this, it's not one of those videos where it's like, listen, follow this strategy. It's insanely profitable. There are many strategies out there, hundreds, if not thousands, that are very profitable. Okay, for traders, so long as you execute consistently and proficiently. But what I have found is, depending on what mode the market is in, depending on what cycle the market is in, certain strategies will be more favorable than others. And so what I'm going to explain today is something that not only has been very profitable throughout the course of this entire bear market, but especially when we are in those range bound days, those days of consolidation. Okay, now the market really just runs in two different modes. There's either your trend mode, where we're pretty much moving in the same direction. All right, you've got your pullbacks, which are natural. Okay, and then you've also got your modes where it's really just that range bound, that chop, that consolidation. Okay, sometimes we'll be moving up, we'll consolidate, for another leg in that same direction. And other times we'll consolidate, we'll break support, and then we'll change direction, and vice versa. If we were starting in a downtrend, consolidate, maybe move, that next leg down, or we kind of break that resistance and move to that next leg up. But this strategy is one that is just very favorable, like I said, in days of consolidation, such as, today, but also throughout the entire bear market. All right, we're not in 2020 or in 2021 where, every single time a stock, breaks through that resistance, it didn't matter what your execution was. You just slapped it and you continued, you added into it. And it's like 9 out of 10 times, as long as you didn't mess it up, you were profitable. That's the market that we were in. Okay, that was that, euphoric cycle, that easy money policy where everything just consistently ran. Well, obviously, as you know, we are not in that market cycle. So I'm going to break something down for you. All right, I hope it gives you guys just a little bit bigger picture. All right, and over a study of 20, 40, 50 trades, like I said, it can be a very profitable system, and it's been one that has just been very favorable for not only me but a lot of people inside the group. So let's get started. First off, for everybody who is not inside the group, I kind of give out some of these plays that I'm looking to get into, and I'm also talking about resistance levels and support levels. Well, today I had my eyes on the indices. I had stated that QQQ had a pretty solid support down to that 280 area, and we also had SPY somewhere around that 393 to 394.20 as of support. I know this is slowly getting cut off for you, but I don't want to change the screen. But those are the two levels I was looking at for you guys. Okay, so or for trades to be inside this market. So here we are. That brings us to today. Okay, and that brings us to the strategy. So first of all, one thing that I've really been trying to get away from is buying these breakouts, right? You had these breakouts, really not only just breakouts to the upside, but breakouts also to the downside that are failing. It seems like, these flags used to form, all right, they would kind of consolidate, they'd break up. Once you get up here, it was just like long it and boom. And as you can see yesterday, Microsoft, which this was building a beautiful flag that I was looking at in the morning, it's just you're getting that fake out, all right? And you're getting in, you're buying up here, which is something that was very profitable back in 2020 and even a good part of 2021. And here you are, you're literally buying calls at the top. Okay. The IV is pumping. All right. Let's say if you're getting in at $2, by the time it even pulls back and it curls, depending on the expiration, you're out at a 30, 40, loss, but before you even give it a chance to really move. So that's something I've really started to steer away from. If a stock runs without me, that's okay. So long as you're consistent and efficient with this, it can be very, very profitable. So I'm talking about buying reversals, and there's a couple things that you need to not confuse this with. Okay. First of all, this is not fighting trend. Okay. When you see days where, it's just, we break out, we get up here. Okay. And it's just consistent moving, slowly moving higher and higher and higher. You don't want to fight that. All right. You're fighting trend. We might get a pullback. You don't want to fight trend. You only want to, look at these days when you see that we are in a bit of a consolidation, which clearly we had that move down. Okay, this is a beautiful example. You didn't want to fight trend, going back to Monday or even Tuesday. All right. It's very different than buying a reversal, but we're starting to base here. We're chopping, right? We move back down. We got some support over here. You can see this is just looking at the cues. These are the days that you want to look to buy the reversals. The reason being is because the risk to reward, right? And so one thing I'm always focused on, and I try to share with everybody, and this really comes from a business, standpoint, because I ran a business before, I still do, but I ran businesses before I got into trading, really trading, full time and heavily. And you're always looking for, okay, what's my positive cash flow? What's my net ROI? What are my probabilities if I do X and Y, if I spend this in marketing, if I search this, what is my return, what am I expected to do, and what are my projections? That's business 101. And when you're trading, you need to treat it as a business. So something I always look for is that risk to reward. And when you're buying reversals, okay, your risk to reward is very high. If you are unfamiliar with what I'm talking about, risk to reward, and even if you think you're familiar but kind of unfamiliar, just literally look it up. It's a formula used to measure the expected gains of a given investment against the risk of loss. One thing that you will not be able to find out is what is your expected gains going to be. Okay, so for example, I had said to everybody inside the group, I'm looking for the 393 to 394.20 on SPY. QQQ was a little bit more precise. Sometimes it's another ticker, sometimes it's an indice. It just so happened I saw where we were on that 282. We were slowly grinding up. Volume wasn't too heavy. We got that, pullback. And I said this somewhere around, 9:15. I send this out every single morning, and I saw it hit beautifully. Okay, we bought calls right off this level and moved to the upside. Now, it doesn't matter and I really want to break this down for you guys. It doesn't matter this is a profitable trade. All right, I'm not going to sit here and be like, oh, these 1 day expirations went 130% and 0 day probably went 200%. That's completely irrelevant. Okay, the point of the matter is, what is my risk to reward, whether it is a profitable trade this time, okay, because out of a sample of 20, 30, 40, 50, 100 trades, okay, you might say, 40% are going to be profitable, 50% are going to be profitable, but you cannot tell which trade is going to be profitable and which trade is going to be a loss. That's why you need to be, consistent and proficient with when you are executing. Okay, so like I said, it came off of this, and it's all talking about risk to reward here. The reason why I like risk to reward on reversals, when you break it down, it's a beautiful diagram talking about what my risk to reward is, okay, and what my success rate is in order to really become profitable, right? So if you're getting in and you're trying to buy these breakouts, right, where you're buying it, let's say the options contract's $2, your cut, really isn't going to be until a dollar, let's say even a dollar. Just that's a 50% downside. Okay, you don't know what your expected upside is going to be. You could look at upside targets and have projections of where you might be 100% winner, it might be a 50% winner, but you never really know your upside. Okay, but you can always really tell where you're going to cut. Right, you should always know where your stop out is going to be before getting into a trade. And when you're buying breakouts, your risk to reward, especially in not only the bear market we are in, but when we are in days of consolidation or chop, which, by the way, after you see, a solid trend day, or especially 2 solid trend days in one direction, it's very common for the market to cool down, base, take a breather. Okay, you can go back and look at days and you can see exactly what I'm talking about. These are the days where you want to look into playing reversals because they offer a much better risk to reward. Okay, so when you break down this play, all right, and I trade on the 3-minute chart. I'll use the 5-minute chart for kind of some clarification, just in case I'm missing, an EMA that might be around it. That's really just my specific strategy. But I knew that, listen, if I bounce off of this, I'm going to look to get in somewhere around this 280 because 280 is a huge psychological level. And if we knife through this, I'm going to cut, right? And so the options that I had played, it was the 283 calls, okay? When you come over here, this is actually the chart that is up. I was looking at this chart, and if you're not charting options, please do so. I've mentioned it in multiple videos. You can go back and look through some of my other videos that I've made on how to chart options and why, premiums have ranges as well. I had seen that, you could kind of see we're getting closer to expiration. So that baseline is just going to be a little bit different. It's not going to be so much as a solid support. It's going to decrease naturally because of theta and such. And you can see here we're slowly moving down, but I could see this pattern slowly forming of this, this downtrend, of support. But I was trying to get in here around somewhere closer on the dollar range. It didn't really quite get that low, is because, like I said, I'm trying to time this, not really knowing what the contracts are going to open up as. I ended up taking my first ad at 122. Okay. And when I saw this, I said, listen, I was like, my cut is going to be, okay, somewhere below around that $1.10 mark. Once we get to this, we get a smash below this. If it knifes, it's going to be unfortunate. But my cut was going to be somewhere around that, that $1.05 to $1.10 mark. Once we got a little bit closer and I saw where we were pulling, once we get into it, I said, okay, my cut needs to be sub $1. But I started adding into this position, which I always scale into my positions. Okay, 1/3, 1/3, 1/3. I started scaling in at $1.22. I took my final ad at $1.15. My average was somewhere around $1.18, maybe $1.19. And my cut was going to be just under $1. So my risk on that one is about 20 cents, okay, which breaks out to be about 17, 18%. Okay, it's a very small downside. All right, and now obviously I don't know what my potential upside is going to be. Are we going to bounce off that 200 EMA? Are we going to rip back up to this pre-market, kind of consolidation area and fade? Where is it going to be? However, once you start turning into the different directions, especially when it comes to options, that's when IV starts to change, your delta starts to ramp, and your gamma, and the contracts just insanely rip. And as you can see, they went all the way up to almost $3. I started scaling once we got around this $1.87 mark, because like I said, that was the open high for this. I didn't know if we were going to be able to get back above that 282 level, which was another level of resistance. That's when I started scaling, had some runners, ended up getting stopped out for the rest of them after I took some scales up here, stopped out for the rest of them somewhere around this area. I didn't want to break. I really thought we weren't going to break that 184. As you can see, premiums have ranges, and it's continued to bounce off of here. So guys, please leave a comment down below. All right, if you have any questions about this, it's one of the really good opportunities when it comes, especially like to range bound days. You're not fighting trend. It has a very good risk to reward. When you're getting into them, you have your stops that are such a, you're literally buying as close as you can to your stop loss, that your downside is outweighed by the potential upside. The upside might only be 20%, 30%, and so forth. Or in this case, it could be 200%. If you played 0 days, it was probably even more than that. But I hope this video helps you guys. Leave a comment down below if you have any questions. I'll see you in the next one.